It's one of the biggest questions in finance. How is it that when markets are in total freefall, think 1929, think 2008, some people don't just survive, they actually come out way, way richer? Let's dig in. You've got these almost legendary stories, right? Joseph Kennedy in 29, Michael Burry's Big Short in 2008. So, was it just pure luck? A roll of the dice? Well, according to the source material for this explainer, it's not luck at all. It's a formula. Yeah, the idea is that these massive profits aren't some happy accident. They are the result of a very specific four-stage playbook that a handful of investors seem to follow with, almost mechanical precision every single time. So here they are, the four stages we're going to break down. First, the exit, then the insurance, after that, the short, and finally, the buy. This is basically the roadmap for how some fortunes are made when everything else is falling apart. All right, let's get into the mechanics of this thing. We'll look at how this pattern has played out in the past and what the theory suggests might be happening as we speak. The first two stages are all about playing defense and getting prepared. It's about spotting when the party's getting out of hand and then actually doing something about it before the panic sets in. Okay, stage one, the exit. This is where it all starts. These investors start selling their stuff not when everyone is freaking out, but way before, like 12 to 18 months before. They're selling into a euphoric market when prices just don't make any sense anymore. And what's so wild is how this pattern just repeats itself with different flavors. In 1929, you've got Joseph Kennedy seeing shoeshine boys giving stock tips, realizing things are nuts and getting out. Then, almost 80 years later, Michael Burry sees the same kind of bubble, but this time in housing, and he literally invents a new way to get out by betting against it. So what about today? Well, according to the source, this quote right here is a massive signal. This is from Warren Buffett's latest shareholder letter. When arguably the greatest investor of all time says he can't find anything good to buy, that's a classic stage one indicator. And to put a number on that feeling, just look at the Buffett indicator. It's a simple ratio comparing the stock market's total value to the economy's size. Buffett himself has said that once you get over 120%, you're in the danger zone. Well, right now, it's sitting at 185%. And it's not just Buffett. The source points to these signals everywhere. Berkshire is holding a record-breaking pile of cash. You've got guys like Jeff Bezos and Mark Zuckerberg cashing out billions of their own stock. And corporate insiders are selling at rates we haven't seen since right before the 2008 crash. The argument is that the smart money is already long gone. So once you're out, what's next? That brings us to stage two. This isn't just about sitting on cash. No, it's about actively buying insurance that will pay off big if the market tanks. And the real key is to buy this stuff when nobody's worried, because that's when it's dirt cheap. And the payoff for getting this right can be, it can be absolutely astronomical. Just look at Bill Ackman back in 2020. He put down $27 million on a type of insurance, and when the COVID crash hit, that bet turned into a reported $2.6 billion, a 96-to-1 return. That's the mind-blowing power of a well-timed insurance play. All right, now we shift gears from defense to offense. Stage three is where things get really aggressive, really surgical. This is about moving beyond general protection and actively betting against the weakest parts of the economy. And this is a super important point. Stage three is not about shorting everything. It's about precision. It's about identifying the specific sector, the specific companies that are sitting right on the fault line of the coming earthquake and placing your bets there. And here we go again with the parallels. In 2008, the target was subprime mortgage bonds and the banks holding them, right? Today, the source argues the target is just as clear: commercial real estate, or CRE, and the regional banks that are drowning in those loans. It's the same play, just a different target. So why commercial real estate? Well, it's described as a death spiral. Think about it. Remote work means office vacancy rates are through the roof. That crushes building values. Then here's the trigger. Over $2 trillion in old, cheap loans have to be refinanced in the next few years at today's way higher rates. That's pretty much impossible. So defaults start to cascade, and who gets hit? The lenders holding all that debt, mostly regional banks. And all of that leads us to the grand finale of the pattern, stage four. This is the payoff. This is the moment where all the preparation from the first three stages gets converted into what the source calls the creation of generational wealth. Now, the strategy sounds simple, but it is incredibly hard to do in the moment.
It's about taking that cash you protected, plus all the profits from your insurance and your shorts, and deploying it when there is, blood in the streets. You're buying up amazing quality assets when everyone else is panicking and selling for pennies on the dollar.
And history is just filled with these legendary examples. Joseph Kennedy buying up assets during the Great Depression, Warren Buffett stepping in as the lender of last resort to Goldman Sachs in '08, getting incredible terms, and Bill Ackman, again in 2020, taking his winnings and scooping up stocks like Starbucks at the absolute bottom. And this isn't just a history lesson. Right now, private equity giants like Blackstone and KKR are sitting on record amounts of uninvested cash, what they call dry powder. This isn't money for today's pricey market. This is a war chest, just sitting there, waiting for the stage 4 fire sale. So, where does all this leave us? Well, according to the source material for this explainer, this pattern isn't just repeating. We are in a very specific phase, late stage 3. The defensive moves are done, the targets are identified, and the bets are being placed. So just to recap the whole playbook real quick. First, you exit the market when it's crazy expensive. Second, you buy cheap insurance against a crash. Third, you place those very targeted bets against the most fragile sectors. And finally, you use all that capital to buy amazing assets at the point of maximum fear. So the source lays this out as a clear historical cycle. It argues that stages 1 and 2 are pretty much done, and that we're deep into stage 3 right now. If that theory holds water, it leaves us with one final and pretty crucial question to think about. What does that mean is coming next?